bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 8th, 2025 episode. I do hope you had a wonderful 4th of July weekend, and I do want to start off by thanking my partner, Tony Grappone, for guest hosting last week's episode of the podcast. He was on the podcast along with our partner, Josh Morris. And Tony is one of the 3 guests you can see on the screen if you're watching this on YouTube. Tony, as you know, works out of Novogradac's Andover, Massachusetts office and leads Novogradac's Renewable Energy Tax Credit Working Group. And as you can see on the screen, my other 2 guests are Peter Lawrence, Novogradac's Chief Public Policy Officer, and Jason Watkins. Jason's a partner based in our Atlanta office, and he leads our Opportunity Zones Working Group. My guests, you won't be surprised, are here to talk about the reconciliation legislation that President Trump signed into law last Friday. It's a subject that affects nearly everyone involved: affordable housing, community development, clean energy, and historic preservation. Now, Peter and I did have a podcast on the House version of the bill in late May, and the bill did take a dramatic turn in the Senate, so a lot of provisions that were in the House bill were changed by the Senate. In today's podcast, we're going to talk about the provisions in the legislation that affect affordable housing, community development, and green energy. And it's going to be easier for us to do a deeper dive on affordable housing and community development than on green energy because of how dramatic the changes to green energy were. But Tony will do a great job on that front. Now, Peter's going to also explain how the bill was passed, and then we'll go through the specific provisions around the local housing tax credit, opportunity zones, the new markets tax credit, and renewable energy, as well as discuss other cross-cutting provisions that affect multiple community development tax incentives. And then we'll also talk about what's not in the legislation and what the next steps are for some of those provisions. It also won't be a surprise to our audience that this isn't the only venue for getting more information about the reconciliation bill. We will have a webinar this Friday on the local tax credit provisions where we do a deeper dive. And we do have a planned webinar on opportunity zones where we'll discuss the regulatory road ahead for opportunity zones. We also are planning a webinar on renewable energy tax credits, focusing on the accounting and tax implications of the various phase outs. Now, as you can imagine, there is a lot to discuss. So if you're ready, let's get started. Peter, Jason, and Tony, welcome back to Tax Credit Tuesday.
Thank you, Mike.
Thanks, Mike.
Now, each of you have been guests many times on this podcast. So to a certain extent, you probably don't need much of an introduction, but I'm going to give you an opportunity to do so. If you could share briefly what some of the services are that you provide to Novogradac clients. And then Peter, we'll start with you and then go to Tony and then go to Jason.
Thanks, Mike. As the head of Novogradac's Public Policy Department, we hope that you will consider us if you ever have a public policy related problem. We've been engaged by a number of clients to develop new proposals, address challenges in regulations and guidance. So that's something we're certainly open to doing, and there's plenty to dive in with this new bill work that we could have. I'd also just note, given that we do also have 2 heads of our working groups, we do a lot of our work. I want to encourage folks to join our working groups because they're going to be really busy focusing on how this legislation is going to be implemented through regulations and guidance. And, we have Tony leads our renewable energy working group. Jason leads our opportunity zones working group. And we have a low income housing tax credit working group and a new markets tax credit working group that will all be very busy, focused on doing all the work associated with getting the best possible regulatory outcomes from this legislation.
Great. Thanks, Mike. Hey, it's great to be back on the podcast. So as far as services that I provide, As folks probably know, I kind of oversee 3 different silos of services. I've got a transaction advisory practice where we focus on financial forecasting, projections, you know, tax consulting, gap accounting consulting, you name it. Then when you get into the other silos, we've got a group that does financial statement audit services, reviews, compilations, and then there's a third silo focused on tax return preparation. That's all in addition to the leadership I help provide to the renewable energy working group that Peter alluded to.
Right. Thank you, Jason.
Sure. I provide audit, tax, compliant, OZ compliance and consulting services to my clients, a particular focus on opportunity zones. As Peter mentioned, I also lead the Novogradac Opportunity Zones Working Group. That is a collection of stakeholders. We work together to come up with best practices and also make recommendations for both statutory, which now may be over, at least for the time being, and as well as regulatory changes. And so the next year plus is going to be a very busy time for us working through the implementation of the new OZ legislation.
Yeah, you're going to be very busy along with Tony and Peter on the regulatory front. And who knows, maybe there will be an opportunity for some statutory changes as well. And with that, Peter, before we get going and doing a deeper dive on what's in the bill as applies to community development, if you could level set, share with the audience how we got to a bill that was enacted, that passed the House, passed the Senate, then passed the House, and then was signed by the president.
Yes, Mike, and I'll give an abbreviated version because you could do a whole podcast on the history of this bill, but we don't have time for that today. But I think, of course, right after the November election, when we knew that the White House was going to be held by President Trump and the House and the Senate were going to be in Republican hands, we knew that one of the biggest priorities for this Congress would be addressing all the various pieces of the Tax Cuts and Jobs Act that expired, including opportunity zones in particular. And we knew this was going to be one of these once in a generation pieces of tax legislation, where there is a better than usual opportunity to advance tax proposals, and indeed it did turn out to be that case. The House, did by narrow margins first, pass the budget resolution that included reconciliation instructions, and then that was shortly before Easter. And then after they came back from Easter, the House took up the actual reconciliation bill that passed before Memorial Day. And then the Senate followed, and they met this ambitious timeline, which we always thought was going to be a challenge, but indeed Congress did come through and pass the final reconciliation bill before the July 4th deadline. And it is a very comprehensive, large tax legislation, more than $4 trillion worth of tax provisions, including the items we're going to be covering in this podcast today. So it wasn't easy. It was very narrow margins all the way through the process, including the narrowest margin possible in the Senate, 51 to 50. And, also the House vote was very, very narrow too, 218 to 214, with only 2 defections among House Republicans. So I think that's where we are on that. And we can dive into the elements of the legislation.
So let's dive right in, and we'll start with affordable housing. We've been waiting a long time to get some of the provisions enacted that were enacted. And many will remember not too long ago when we got really close and the House passed a bill that would have had a couple of expansions of the low income tax credit that the Senate ultimately did not move forward. So please describe for our audience the key provisions that affect affordable housing that were included and have now been enacted.
Sure thing, Mike. So first, I guess the simplest provision was an increase on the 9% allocations of 12% for both the per capita and the small state minimum allocation. And this is a permanent increase. So unlike what was done back in 2018 and what was proposed in the past. It is a permanent. It is 12% flat, not 12.5%, which had been talked about in the past. But that really having that bringing back the baseline for 9% that we lost for a number of years when the original 12.5% increase expired in 2021 is a great impact, especially for new construction, given that 9% credits are most often used for new construction. And then the other major provision, which is likely to have the largest unit financing capacity of the two provisions, is a lowering of the private activity bond financing threshold from 50% of land and building costs to 25%. And this is a really huge victory. It really unlocks a lot more potential on the private activity bond financing side of the low-income housing tax credit. We did an estimate here in Novogradac that if states choose to reserve all of that free bond camp from this provision for rental housing, and that there is sufficient gap financing resources in the state, that we could, along with the 12.5% increase, finance 1.22 million affordable rental homes more than expected in the coming decade as a result of these provisions, which is really potentially a huge impact. We have a tremendous affordable rental housing supply deficit in this country, and these resources are sorely needed to help address that crisis. And I'll just also note a couple of things about the 25% test, Mike, I think is important for folks to know. One is, the effective date for it is properties placed in service after 2025 that have at least 5% of the land and building costs financed with bond issuance starting in 2026 or later. So you could potentially, for example, get an allocation that would cover 20% of your land and building costs now, even before 2026. And then if the state would give you the additional 5%, or maybe a little bit more so you have a cushion in 2026, that you would satisfy the 25% test. So you don't have to wait really until 2026 to really get started on making use of this provision. It's really helpful. And then one other thing quickly, Mike, before I turn it back to you, and that is the legislation also allows you to treat the acquisition and the rehab portion separately. So if you had to acquire the property in 2025, that would still have to, that portion would have to apply the 50% test. But the rehab portion, if it was placed in service after 2025, that could potentially adhere to the 25% test. So that opens up possibility to be able to have more flexibility in applying that 25% test and enable you to, even if you'd already acquired a building, to take advantage of it.
And I know you'll go into this in more detail this Friday on the webinar. I encourage our audience to sign up for that webinar. But I would just note that your discussion about the 5% being financed by bonds issued next year or later, basically shoehorning in transactions that have less than 50% but got allocations from bonds issued this year, is something that means a lot of state agencies are going to start evaluating how they're handling their bond cap this year, rather than just go and give a full 50%. Many may end up starting to pare that down so they can get more housing financed. I'd also note that as you were mentioning the amount of units that are financed, there's been a real need for preservation dollars. And a lot of states have been moving their bond cap towards new construction. And the one thing that this does do is the fact that states can now finance a lot more units with private activity bonds. We do expect to see many more acquisition rehab transactions being financed with private activity bonds. Used to be the case that a great number of them were in there over the last 4 or 5 years. More and more private activity bonds were being used, given priority to new construction. And now that they can increase the volume, there should be more ACT rehab dollars. I know we're talking to a lot of clients about that right now, but there's so much you're going to be able to talk about in the course of the webinar this Friday. So I'll leave it at that. And now let's move over to opportunity zones. Jason, I'm going to scoop you and say, please talk about the permanency of opportunity zones.
Well, that was my first word. All right. That's the biggest news in this bill, as far as opportunity zones are concerned, is that it's permanent. It's now made a permanent part of the tax code. The House version was offering a one-time renewal, essentially, whereas the Senate version makes it permanent. And as a part of that permanency, there will be new rounds of designations of opportunity zones that will occur every 10 years. The first new set of opportunity zones is scheduled to be in place by January 1st of 2027. Now, the existing opportunity zones are still in place through the end of 2028. If you recall from the House version of the bill, they were going to sunset early at the end of 2026. That was reverted back to the original date of December 31st, 2028. So there will be a 2-year overlap in opportunity zones from 27 and 28. Additionally, there was a special rule that was put in place after Hurricane Maria in Puerto Rico that made all Puerto Rico's low-income census tracts opportunity zones that will end effective December 31st, 2026 as well. As far as what census tracts will be eligible, there's some modification there too. The current opportunity zones were based on an 80% area-wide median income threshold. That's going to drop to 70%. And the impact of that is because governors will still be limited to a total of 25% of low-income census tracts being eligible for designation. That means that there's going to be a reduction in the total number of opportunity zones, estimated somewhere between 20 as much as 30% once you take into account the Puerto Rico tracts that will no longer be designated as opportunity zones. So there will be a significant decrease. There's 8,700 or so now. The number's projected to be, more along the lines of high 6,000s to low 7,000s once the new round is designated. There are some other rules put in place. I won't go into too terrible much detail here, but it will be discussed in more detail in the webinar that we plan here in the next few weeks. So that's sort of everything related to redesignations of opportunity zones and permanency. There's also a number of changes that went into effect for how investors treat their investments. In what we refer to as, or what is the 1400Z-2 part of the code, which is currently there was a single deadline date that all investments, the gain on all deferred gains was going to be recognized. That's December 31st, 2026. And that's still in place for investments that have been made to this point, and also for investments made between now and the end of 2026. But effective for investments made on or after January 1st of 2027, investors will be entitled to a 5-year deferral, a fixed deferral window, after which the gain would then be recognized.
And let me just interject there. When you say investments, it's investments in the Qualified Opportunity Fund, as opposed to what the fund makes investments in product, right. The rest with investments in the fund in 2027 and later eligible for the new deferral.
That is correct. And so what that means is that capital gains that are recognized during calendar year 2026, depending on how they're recognized, there's a good chance that most of those would be potentially deferred through an investment at January 1st or later of 2027. So that's exciting news. It does lead to some potential slowdown in investment between now and January 1st, 2027. And again, we'll get into that in more detail as a part of our webinar upcoming. But some other benefits that are part of this. So similar to the current OZ provision, an investment held for 5 years was entitled to a 10% basis step up, meaning that 10% of the originally deferred capital gain be forgiven. It would not be taxed if the investor had held their investment for 5 years. Unfortunately, because of the fixed date of December 31st, 26, for the recognition of all the deferred gains, every investment since December 31st of 2021 hasn't been able to take advantage of that 10% basis step up. But that goes away now because every investor, if they've held their investment for 5 years, which they'll be encouraged to do, because that's how long the deferral period is, will also be entitled to a 10% basis step up. And then this is further sweetened by investors that are investing into rural opportunity zones. And that is tripled, so that the amount of the originally deferred gain that can be tax-free after 5 years is up to 30% for investments into rural opportunity zones. So that's pretty exciting. There's a lot of rules around that. We'll go into much more detail as part of the webinar, but that's very exciting. I think that was a big push coming over from the House side of this legislation, because there were a number of specific incentives to encourage investment into these rural areas. They didn't all make it into the Senate version and into the final version, but I think it was a good starting point. And I'm already fielding a lot of phone calls from folks that are interested in now investing in rural opportunity zones. So it should be very interesting to see how this develops. It's going to be an interesting process as you go for the next year and a half and people begin to strategize.
So thank you for that. And I just want to emphasize that rolling 5-year deferral is for investments made in 2027 or later. Investments in 2025 and 2026, investments in qualified opportunity funds, gain would be recognized at the end of 2026, and there's no exclusion aspect to that, which is one of the reasons why Jason was referencing that, gains in 2025, if you're going to participate in opportunity zones, you pretty much have to invest by 12/31/2026, depending upon when the gains recognized and the rest, but certainly you have to invest before 2027. And with respect to gains in 2026, as Jason noted, some of those gains, depending on how they're recognized, you'll be able to wait as an investor and invest in 2027 and get the benefit of the 5-year rolling deferral. So we do expect there to be a bit of a slowdown, particularly in 2026 with respect to opportunity zone investment. I also wanted to mention, maybe you could say a few words about this, Jason, that there's a host of regulatory issues that kind of back in the day when we were dealing with OZ 1.0, there were various requests that we made to Treasury, and Treasury was in the process of standing up the entire set of regulations. And the one thing about opportunity zones, it's very cross-cutting across the entire tax code. So there was a lot of issues for Treasury to deal with. And that now that we've got opportunity zones 2.0, there's going to be a need for a number of regulatory rules to be released by Treasury. And as part of that, say a bit about what the Opportunity Zones Working Group plans to do in terms of revisiting a number of the regulatory matters that never moved forward at Treasury in the prior effort.
Right. With the initial sense of the proposed regulations, and then as those were finalized, Treasury declined to author regulations around numerous topics that we think now are worthy of revisiting, in addition to a number of aspects of this new legislation that are going to need regulations put around those. These range from how the transition periods are going to work from one set of opportunity zones to the next, and how the substantial improvement rules work, and how the working capital safe harbor works. Anyone who's spent much time with opportunity zones is well aware of some of the gray areas we have around the working capital safe harbor process. So we're looking very forward to revisiting these. The working group has a number of years now worth of ideas that we intend to reintroduce, and then we're also brainstorming now to come up with additional ways that the opportunity zone incentive can be better rolled out as we move into an opportunity zones 2.0 regime.
And I would just emphasize beyond, in addition to all that you talk about there, affordable housing, see what changes we can get regulatory to facilitate affordable housing. I'm even willing to revisit interim gains, willing to kind of revisit the way in which improvements of property get treated There's a lot of more technical issues there to be addressed. And that is something that Jason will be talking about in more during the webinar, which is one of the reasons why we talk about the regulatory road ahead. It's not just for implementing the new law, it's also revisiting old wine. Hopefully we can get them into new bottles and get them into the treasury regulations.
Absolutely. There were a lot of things we would have all liked to have seen in the legislation, but we do think there is going to be sufficient opportunity and a good opportunity to get some of those, if not most of those
Yes.
provisions through the regulatory process instead.
And I should also give a shout out to operating businesses as well. There's just a lot of these little a lot of these areas where we want to see Treasury issue regulations that are more conducive to facilitating certain types of activities and opportunity zones. So, Peter, maybe you could, please do address new market tax credits.
Yeah, there's a big headline there is new markets credit after 25 years has been made permanent in this legislation, which is a huge, fantastic achievement. We saw that once the low-income housing tax credit was made permanent in 1993, investors really changed their perception of the credit, invested in the sort of infrastructure associated with taking advantage of the low-income housing tax credit. I anticipate there will be a similar dynamic happening for new markets. It's really, it's great to not be having to constantly fight for survival and in a continual sense of pushing for extensions, temporary extensions. Having that permanency is a huge benefit that we anticipate. I will just note that, of course, there wasn't the other two elements that were a part of the permits legislation we've been advancing, being annual inflation adjustments, as well as the ability to take the new markets credit against alternative minimum tax liability, like you can do for the low-income housing tax credit and historic tax credit. So there's still to-do items, legislative to-do items for new markets. But I think people are very, after not being addressed at all in the House version of the reconciliation bill, it really was quite an achievement to turn the tide and get new markets included as permanent in this legislation.
I mean, I will say that when I testified in front of the Senate Finance Committee a year ago and talked about how opportunity zones and new market tax credits had earned a right for a permanent place in the tax code, if you had told me a year later that actually would have happened, I would have said that is a wonderful thing, but I definitely wasn't necessarily expecting it to happen as quickly as it did. So that's very wonderful. So, Tony, let's turn now to renewable energy. The Republicans definitely took aim at the Inflation Reduction Act and made severely restricted and dampened the future of clean energy. The House bill was particularly bad, but the Senate bill, isn't as bad as the House bill, but still, changes the arc of growth under current law. Please describe the impact in the shorter term of the tax bill on the renewable energy community.
Sure. Yeah. Thanks, Mike. So before I dive into the renewable energy aspects of the bill, I just want to take a moment and say I can't believe it's been 25 years since the new market tax credit program first came into existence. And with respect to opportunity zones, it almost seems just like yesterday that program was enacted, and you had this you could see this sort of like 2026 out date for gain recognition deferral. And at that time, a lot of people were thinking 2026 seems like a long time from now, but time flies, right?
Yes.
So time flies could almost be a bit of the under theme of this this podcast. So it seems like also just yesterday when we were early May, we were in Chicago at the Renewable Energy Conference right around the time that was like when we were starting to see some draft text language around the House bill, and then shortly thereafter passed the House, and then it went over to the Senate. And the clean energy provisions have, some of the key clean energy provisions have certainly kind of moved around a lot since the first House draft came out, from when then it got passed, and the Senate, et cetera. And so what I want to focus on are probably the most frequently asked questions that we get with respect to the bill and how it impacts wind and solar clients. Because as most people know, the bill takes, particular aim at the wind and solar industry. So the bill has a lot in it with respect to clean energy, of course. And so, but for today, what I'm going to do is I'm going to focus most of my comments really on wind, solar, battery storage. And then we'll save diving into some of the other aspects of the bill that impact, say, 45X and, geothermal and green hydrogen and the other technologies. I'll sort of save those remarks for a future podcast. Okay.
Okay.
Yep. So, all right. So there's been a lot of questions around when facilities start a construction is like a really hot topic when it comes to wind and solar facilities right now. Actually, it goes beyond wind and solar, but particularly impacts wind and solar facilities. So a lot of questions around when a facility needs to start construction and be placed in service in order to preserve eligibility under the various tax credit rules, as well as when the foreign entity of concern or FEOC requirements kick in. As you know, earlier versions of the House and Senate bills differed in these regards. And so I want to highlight the most relevant dates that wind and solar developers should be aware of with respect to commencing construction and getting their facilities placed in service. Okay. So this timeline I'm about to walk you through applies to wind and solar facilities. And then I'll provide some comments on battery storage after that. Okay. So first, I think people should be aware that if you're a developer of a wind and solar facility and you started construction before 2025, well, the facility is still eligible for credits under old sections 45 and 48. And what that means is that these facilities are not subject to FEOC, and they are not subject to this 2027 place in service cliff that's in the final bill. Okay, so I think most people in the renewable energy industry are aware that for wind and solar facilities, there's a provision that requires wind and solar facilities to be placed in service by the end of 2027. Okay, but there are some nuances to that, and I want to kind of walk people through those nuances. All right, but if you started construction before 2025, the 2027 cliff date doesn't apply, and neither do the FEOC rules. All right, now you move into 2025.
Let me just interject there and compliment you. When we had a podcast last year, we were talking about how to grandfather your project under the old rules. And I remember you saying that theoretically applying under the new rules wouldn't be very different, but that you know what you know now, and you were encouraging your clients to try to grandfather themselves so you lock yourself in. And that was very good advice that you gave to your clients. So kudos to you.
Thank you. Thanks. I appreciate that. Yeah. And a number of folks did reach out, and we helped them kind of document and start a construction profile last year. And we do that pursuant to an agreed upon procedure engagement. So I won't go into all the details of what that involves. We have podcasts where we discuss how we help clients document and prove that when they commence construction. So if you need to do that, please reach out to me and we can help you figure that out.
Also, on that upcoming webinar, you'll go into detail on that.
Yeah, we have webinars scheduled for things like helping people better understand how to commence construction and how to document when they start a construction. We'll have webinars on, the domestic content criteria, satisfying the FEOC criteria, and of course, prevailing wage and apprenticeship is still a very hot topic in renewable energy. So we have plenty of upcoming webinars to help clients understand how to meet these various tax rules. All right. So let's say you didn't start construction before 2025. Well, if you're a wind and solar developer and you started construction after 2024, but before 2026, well, now your facility is subject to the tech neutral credits under sections 45 cap Y and 48E. However, the facility, if you start construction after 24 and before 26, although you're under the tech neutral credit provisions, your facility is not subject to the FEOC requirements, and the facility is not subject to that 2027 place in service deadline. You've got 4 years to place your facility in service. Okay. Now, What if you start construction after 2025? Well, if you start construction on your wind or solar facility after 2025, but before July 25th, 2026, well, now the facility, you're under the tech neutral credit provisions. Now, at this point, you are subject to the FEOC requirements, okay? But you're still not subject to that 2027 place in service cliff. If you start construction before July 5th, 2026, or within that 12-month window, you've got 4 years to get your facility placed in service, so you've got more time there. Now, what if you start construction after 12 months following the date of enactment of the bill? Well, if you fall into that category, then the facility is under the tech neutral credit provisions, subject to the FEOC requirements, and subject to the 2027 place in service deadline. So you got to get your facility placed in service before 2028. Now, lastly, if you have a wind or solar facility that begins construction after 12 months from the date of enactment, and you do not get your you do not get your facility placed in service by the end of 2027, then you would not receive any credits. You wouldn't qualify for any credits under sections 45Y and 48E. Okay. So there's kind of 5 big dates there to keep in mind. And I imagine, we'll probably list this also in a Journal of Tax Credits article for people to reference as well. Now, that timeline was with respect to wind and solar facilities. So I just want to kind of underscore, we have a lot of clients that are in the battery storage space, and I just want to kind of highlight that the battery storage facilities are not subject to that 2027 place in service deadline. Now, I've made comments about beginning construction. Another thing I want to highlight is that the beginning of construction rules, they appear to be codified in one area of the bill. However, the bill also seems to allow for revisions. And so if you're thinking about starting construction soon, I would encourage you to really try and do that, as soon as you're kind of ready to get underway. Because if the bill seems to allow for revisions to how the beginning of construction rules start, I think it'd behoove everybody to sort of, don't delay when you start construction. All right, moving on from sort of the timeline with respect to wind and solar facilities, I want to make a few comments about the FEOC requirements, okay? So FEOC applies to facilities that start construction in taxable years that start after the date of enactment. So for calendar year taxpayers, that would mean 2026. The bill indicates that additional guidance on how to comply will be issued. However, for now, taxpayers are able to rely on the thresholds provided for in the domestic content safe harbor guidance. So if you find yourself subject to the FEOC rules and you're trying to figure out how to comply, if the Treasury and IRS haven't issued clarifying guidance here, they've said you can rely on the domestic content safe harbor guidelines, the thresholds that are contained in that guidance. I also want to point out with respect to FEOC rules, there's an issue with respect to payments made to prohibited foreign entities. Okay. Starting if you're a calendar year taxpayer, if you make a payment to a prohibited foreign entity, that can trigger recapture. And that payment to a prohibited foreign entity recapture risk issue, that commences in the tax year 2 years from the date of enactment. Or again, if you're a calendar year taxpayer, that would mean starting in 2028. And that would create a 10-year recapture requirement that could disallow all of the credits. So if you make a payment to a prohibited foreign entity during that 10-year recapture period, you would actually be subject to a 100% tax credit recapture event. So I want to highlight that. With respect to domestic content, the final bill resolves some confusion around the percentage of manufactured components that need to be produced in the U.S. The clarification that we got in the final bill means that if you start a construction by June 16th, 2025, then the percentage is 40%. However, if you start construction after June 16th, 2025, but before 2026, that manufactured component is 45%. If you start construction in 2026, it goes to 50%. And then after 2026, it goes to 55%. So whether it's preserving eligibility under sections 45, 48, whether it's trying to preserve a 4-year runway for getting your facility placed in service, when FIOC rules kick in, what percentage you need to comply with domestic content thresholds. There's just like a lot of different reasons why knowing when you started construction is so critical. All right, continuing on in other news, the bill allows this now we're getting away from wind, solar, and battery. I just want to make a point about fuel cell property because we do have a number of clients that operate in the fuel cell space. So the bill allows fuel cell property to qualify for 30% ITC starting in 2026. And it's just a straight up 30% ITC. And the nice thing here is prior to the reconciliation bill being passed, if you want to qualify for fuel cells, you were under the tech neutral provisions, which meant you had to deal with greenhouse gas emissions tests. But now for fuel cell property placed in service after 2025, they don't have to meet those greenhouse gas emissions criteria, and they don't have to meet prevailing wage and apprenticeship requirements either. So a bit of a win for the fuel cell industry. Regarding transferability, as far as it relates to credits that have previously qualified for transferability, there's no real change there other than the credits can't be transferred to a specified foreign entity. With respect to tax depreciation, there were earlier versions of the bill that would have no longer allowed wind and solar projects to qualify for 5-year makers. However, we believe, in between hot dogs and hamburgers this weekend, I'm sort of reading the final bill text, and it appears as though that provision was fixed when it got finalized. And so we're under the impression that 5-year makers is back for wind and solar projects. Okay, moving on, 25D, that's the residential solar credit. So the final bill indicates that there's no credit for expenditures made after 2025. I said the word expenditures. So there is some confusion right now in terms of how to interpret that word expenditure, especially with respect to facilities that may be interconnected and placed in service before 2026. However, final payments on those facilities made after 2025. So that's probably an area where our working group will probably solicit clarity from Treasury and the IRS. And finally, earlier versions of the bill would have imposed a new excise tax on facilities that don't meet FIOC requirements. However, I believe, and Peter can confirm, but I believe the final bill fixed that aspect.
Yes, indeed.
Thank you. All right. So those are kind of again, I wanted to focus on the most frequently asked questions that we're getting from clients, and that kind of gives you the rundown of the major highlights. We'll probably do subsequent podcasts, webinars to address other aspects of the bill and to go into deeper detail on topics, especially with respect to like FIOC, domestic content, beginning construction, etc.
Great. Thank you for that, Tony. That was a pretty thorough overview. And I know there's a lot more under the hood there. And I'll look forward to the future podcasts as well as the webinar on the various tax and accounting issues around energy compliance. So, Peter, I wanted to have you also address some of the other provisions that are in the bill that are more cross-cutting across a number of incentives. So if you could take it away.
Sure thing, Mike. So I think first and foremost, I want to note that 100% bonus depreciation is made permanent. So as you may recall, there was 100% bonus depreciation originally enacted as part of the Tax Cuts and Jobs Act in 2017, and that began to phase down. But the bill reverses that phase down and reinstates that for the property incurred after January 19th, 2025. And that is, I think, something that's going to be beneficial across all of the community development tax incentives. And so that we're happy to see that included. To somewhat of a lesser extent, the limit on the ability to deduct debt from your taxes was also made permanent. The provision under Section 163J did add back depreciation and amortization to earnings before interest and taxes on the calculation. So that may be of benefit to some investments in properties. And I think there are, of course, a couple of other things just to point out that were not included, like there was no cut into the corporate tax rate, which had been considered and talked about as part of as this legislation bill was enacted, and also the tax exemption on both municipal and private activity bonds was not touched. So those remain as something that continues to be a part of the tax code. So I think those are the one cross-cutting items I wanted to highlight in particular.
Great. Thank you there, Peter. I'm not sure if Tony or Jace have any comments on the impact of some of those provisions in your areas of practice.
Sure. Well, with opportunities and the 100% bonus depreciation, just sort of further increases the value for investors. Because after a 10-year hold, the property is sold. Typically, in a non-OZ investment, there will be bonus depreciation recapture, resulting in ordinary income tax. But for an OZ investment, it's been held for 10 years. You get a full basis step up. So there is no depreciation recapture tax. And so investors will be able to accelerate losses without having that recapture at the back end of an OZ investment.
Yeah, and for renewable energy, I would say it's definitely a plus, to have the option. As far as tax equity investors go in the renewable energy space, it doesn't tend to be a game changer in terms of how much investors are looking to invest for tax-related benefits. And that's mainly because they use partnerships for the most part to finance renewable energy facilities, and you have to allocate losses in accordance with tax rules, and that can place limitations in terms of how much depreciation that ultimately gets allocated to the tax equity investor. And so I don't think it'd be a game changer on the tax equity investor pricing side of things. However, for developers that can use depreciation benefits, I'm sure they appreciate the bonus depreciation benefit coming back.
And I would also just add, with respect to local living tax credit investments, the expensing will be helpful in terms of added yield for economic investors, particularly with with your equity rehab transactions. And I'll also note that the 100% expensing has a January 20th binding contract rule. So you do have to determine if there's already a binding contract in place or was one as of January 20th of 2025. If not, it is retroactive to January 20th of 2025. So it is something that everyone should be reviewing. If you place a property in service after January 20th of 2025, you need to be reviewing the transition rule to see if you're eligible for the 100% expensing, which, as you know, you can't always opt out of. So I'll turn to you now, Peter. We've talked about a lot of the good news in the affordable housing, community development space, some of the bad news in the renewable energy space, but there is a reasonable runway. So we definitely expect the renewable energy community to be very actively moving forward and trying to start construction. But there were other asks that did not make its way into the bill that the broader affordable housing, community development, historic preservation, clean energy community wanted. Please give a brief overview of some of the more notable provisions. And if you could also talk about when those more notable provisions, there might be an opportunity to revisit them on a statutory basis.
Sure thing, Mike. I'll start with one that we were thinking had a decent shot to be included, and there has been a lot of activity associated with that, and that is the historic tax credit. Listeners may recall that in 2017, the Tax Cuts and Jobs Act did turn the historic tax credit from a 1-year credit to a 5-year credit. So instead of being able to take that 20% credit in 1 year, you had to take it over 5 years. And given that sort of nexus, we thought there would be an opportunity to revisit that policy decision and see if we could revert back to a 1 year, as well as other potential modernizations of the historic credit, like getting rid of the basis adjustment associated with the historic credit. Both of these were key features of the Historic Tax Credit Growth and Opportunity Act. And Senator Bill Cassidy, an influential senior Republican on the Senate Finance Committee, had made this one of his major asks in the reconciliation bill process. And unfortunately, it did not make it in, which is a bit of a disappointment to the historic preservation community. Now, but in a moment, I'll talk about where there may be future opportunities. Let me talk about a few other things down the line that also did not make it in. Another one is the neighborhood homes investment. This would have created a new tax incentive modeled after the low-income housing tax credit and the new markets tax credit to incentivize the construction and the rehab of single-family owner-occupied housing. The low-income housing tax credit typically is really only rental housing, and there is I think, a dearth of starter homes in this country, and there was hopes that, given that we have the housing crisis applies just as much to home ownership as well as to rental housing, that there would be an opportunity to advance that proposal. And unfortunately, that did not happen either. And then on a sort of going down the line a little bit further, there was also no provisions for the workforce housing tax credit, which would really essentially is the low-income housing tax credit for households that earn just above the income limits for the low-income housing tax credit. We saw that Harvard's Joint Center on Housing Studies released their State of the Nation's Housing Report in 2025, documenting yet further the cost burdens climbing up the income ladder, such that families that do earn above those housing credit income limits find it extraordinarily difficult to find rental housing that's affordable to them. And this applies to firefighters, nurses, school teachers, a lot of them that are having a hard time finding an affordable place near where they work. And this is legislation that had a chance potentially of being included that was not. And last but not least, also is a new proposal to create a tax incentive for the preservation of rental housing. You talked about earlier, Mike, about how the housing credit provisions could help with that, but the preservation challenges are really quite enormous in the coming years. A lot of housing is coming underneath their land use restrictions or their mortgages or their rental assistance contracts. And even with the great news we have on the housing credit, there's probably still, not enough resources to address all those needs. So this proposal would provide yet a new tool to help preserve that through the syndication of tax losses. And we anticipate that will still be, pursued in future tax legislation, which, as you asked me to do, Mike, I can tell you what we're looking down on the pike. I mean, obviously, this is a huge tax legislation that addressed a lot of key issues that Congress needed to address. We didn't mention, for example, that there is an increase in the nation's debt limit to $5 trillion, which should enable the country to continue borrowing and staying under the debt limit through after the midterm elections next year. But also that all the various key tax provisions that were expiring into the year that, if had not been addressed by Congress, would have led to more than 60% of American taxpayers getting a tax increase. That's not there anymore, that impending deadline. So the sort of pressure, the deadlines forcing Congress to act are not necessarily there. But Speaker Johnson did, over the past weekend, did on Sunday talk shows talk about the agenda forward, and he is mentioning that he is interested in pursuing not just one more reconciliation bill, potentially two, one for fiscal year 2026 and another for fiscal year 2027. And so that those two potentially could serve as vehicles for tax provisions there are a couple of things that weren't addressed in this tax legislation, some healthcare related tax extenders, as well as the work opportunity tax credit, which, was married in some respects to the new markets credit, in that they both received a 5%, 5-year extension back in 2020. So we'll see about appetite for Congress for those two reconciliation bills. There's also been talking about a bipartisan tax bill potential for items that have both party support that were not addressed. Both, I had to say, Mike, I don't know what the appetite will be. There's lots of uncertainty on that, and it's really fortunate for all the provisions that did get included, because I think we may be in for a time where there isn't a tax legislation in the foreseeable future. At least I think until potentially the next Congress. So while it's certainly possible there will be one towards sometime later than this Congress, it's not a done deal by any stretch of the imagination.
Yeah, no, I think the over-under betting, there's a likelihood of a bipartisan tax by the end of the year. Most seasoned DC veterans don't see much of likelihood there, but who knows? It's always sort of possible, and you got to act as if it is possible. It'd definitely be interesting to see what the contours of one or two more reconciliation bills might be. And as you know, it certainly creates opportunity for that. And these various provisions are particularly expensive, which is one of the reasons why it's frustrating they didn't get in, but also means that there's a chance of getting in a future bill. So I'll give each of you a chance. If there's anything more you wanted to say, there's so much more we could be saying in the course of the podcast, but there's only so much time. Any last words from any of you? Okay.
I'll start. Okay. So as I said earlier, time flies. So if you're, again, as you go through underwriting and you're trying to do feasibility analysis on the financing side of things, knowing when your facility started construction is critical. So we've been helping clients do that for a very long time. So feel free to reach out to us. We're happy to help you get yourself organized and document when you started construction.
Great. Thank you for that, Tony. Jason?
Yeah, I would just like to say that, if you'd like to be involved in the regulation writing process, I welcome you to reach out to me regarding joining the Opportunity Zones Working Group. Like I said, we're going to be very busy over the next year helping to craft together ideas and recommendations for regulations to help the OZSN do its best.
And could you remind me when the next Opportunity Zones Working Group meeting is? I know it's been rescheduled a few times, given the July 4th holiday and the rest. So I'll give you a chance to refresh your memory.
Sure, no. Next meeting is Tuesday, July 22nd at 3 p.m. Eastern.
Okay, so if you're interested in learning more about the Opportunity Zones Working Group and you're not a member already, please reach out to Jason. Peter?
So, Mike, I want to just point out that I think, in addition to the renewable and Opportunity Zone working groups, I think the loan and building tax credit working group is going to turn to thinking about regulatory issues as well as the fiscal year 2026 appropriations. We talked about the unit financing potential of the 25% test, but you're going to need gap financing. And the Trump administration did propose rather drastic cuts to HUD funding, and those are often key sources of gap financing. So I know the affordable housing community is going to play some defense here on trying to sustain that, as well as look at provisions that potentially might be able to enhance investor interests. We have all this now potential for new credits. I think there's going to be increasing attention on how we can help sustain investor demand. There might be some announcements coming from the federal government that might help us in that respect in the coming weeks. I keep an eye out on, and we'll, I think, the LIHTC working group will be looking at other opportunities and regulations to help bolster investor demand as well.
Thank you for that, Peter. And thank you also, Jason. Thank you, Tony. As I noted, we could talk a lot more about the bill, and we will have follow-up podcasts on these various topics. I do encourage our audience to tune in to the webinar this Friday on the low-income housing tax credit and the impact of the legislation on that. We will include a link to that in today's show notes. We'll also include the emails for Peter, Jason, and Tony if you want to reach out to them directly. We'll also provide some links to some of the blog posts that Peter and his team have been writing about the One Big Beautiful Bill. And then with that, let me also just remind our audience to consider subscribing to the podcast. If you don't already, do please share the podcast with your colleagues who may be interested. And for those of you watching on YouTube, I'd encourage you to like and comment on the video on YouTube. That helps raise our visibility, helps others hear and see important discussions like the four of us had here today. Tony, Peter, and Jason, thank you for being on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.